Hey folks, Bob Desmond here, and welcome to Coffee with Bob. All right, it's about 5 o'clock in the morning. I'm a little bit drowsy still. I'm heading off to the gym soon, so forgive any faux pas. And I want to talk to you today about a follow-up to yesterday's morning video regarding the Fitch downgrade of U.S. debt. We're going to talk about what I had anticipated, and we're going to talk about three key charts on a closing time frame from yesterday. I would ask that you keep an eye on moving forward because you're going to need them in the coming days. One of them, if you're a follower to our live streams on Thursday nights, which is today, we're going live tonight. We'll be talking about them again. The yield curve, the bulls-bear sentiment, and the chart of the triple Qs. So if you're not currently on our live streams, please use the link below, the notification bell, and get notified as to when we go live. We're also going to go over the pre-market futures action, so stick around. We'll make this quick, and let's begin with a follow-up to yesterday's video. Now, going back to yesterday's video, I mentioned that back in 2011, when S&P 500 downgraded U.S. debt, the powers that be, Warren Buffett, Alan Greenspan, former Fed chair, came out and said how wrong it was, blah, 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 blah. And I said, they're going to do it again. And sure enough, what happened is that you had Jamie Dimon come out yesterday with a comment, and I said that they were going to bash Fitch. And here you go. J.P. Morgan CEO calls downgrade ridiculous, but says it doesn't really matter. I'm going to link to that video immediately above, as a matter of fact, if you've seen that link there, because it's so predictable at this point of what they're going to do, because it's all a big game. You are the pawns, including me, and anyone that throws water on their Game of Thrones, then they have a problem with it. And Fitch right now is the latest in the cast of characters that is being demonized, and we've seen this way too much in current years, whether it be politics or what have you. You go against the narrative, and you are in big, big trouble. Add to that you had the Treasury come out, I believe it was yesterday, and say they plan on spending more than they had anticipated with more government debt. So not only are bond yields ripping, we're going to go over that chart in a moment, in the pre-market, because now we're above yesterday's highs. And in fact, we're at highs on the 10-year yield, or we hit highs yesterday. We haven't seen since, I believe it was March of 2022. So new highs for 2023 on the 10-year yield, and we keep spending money, causing the problem to get worse. And of course, now you have Bill Ackman out there saying he's shorting 30-year Treasury bills. Not that I can blame him. He's a little bit, if he's really putting on the trade now, he's perhaps a little bit late to the trade. In the case of the 10-year, he's definitely late. But if the 30-year looks anything like the 10-year, he's a little bit late, and he's probably already been short. Now he's pounding the market down, trying to jawbone his position. And he's predicting a 5.5% yield on the 30-year. But this is the stuff you need to expect as the markets begin to go into a correction, in particular with Bill Ackman. Go back to his comments during 2022, hell is coming. Not my words, his words. And he was already short the market. So all he's doing is talking his book at this point in time. That's to be expected. This is the game. If you're a trader and this is what you signed up for, this is the game. Get ready for it. It only gets worse from here. That doesn't mean you can't make money, folks. We also had Yellen come out and say it was wrong with Fitch to do, blah, blah, blah. It's not even worth finding what she had to say, because it's all about the narrative. If you're against more spending, if you're against ever-increasing levels of debt, you are the demon to the government. You are the demon to the financial sector, unless you're Bill Ackman. And you're to be vilified. And that's what we see. Intellectual dishonesty at least, and nefarious behavior at worst. So let's get to the three charts that you need to look at as we move forward. And I've gone over all of these, every single one of them on my live streams. And I mentioned this one not too long ago, and that is the Bulls versus Bears index. And I mentioned that we had at one point in time last month exceeded This is a monthly chart, so it'll correct early on in the month if we don't close above a resistance level, meaning not correct, it'll adjust for the closing price action. And we were even higher than this resistance level in the month of July, but ultimately we pulled back. We're close enough here for government work to say, you know what, we're at multi-year highs, where in the past we've gone into correction. I have the S&P 500 overlaid here. Here was a shallow correction. This doesn't need to be a massive, nasty correction. So this was a shallow correction. The last time we saw a big spike prior to last month was back here, where ultimately it was resolved after 2 spikes. We had a more meaningful correction. Here we are yet again. What's this correction? I don't know yet. I'm not sure. But this is just a clear and defined milestone of where we're at in terms of sentiment. And it's not good to have way too many bulls out there driving up the market when the market is so ridiculously expensive. How expensive is it? Let's take a look. Another chart we go over on the live streams. Again, hit the notification bell. We have a 5-part video tutorial about my top 5 favorite candlestick patterns. That's linked below. It's free. You'll get notified about a half hour prior to us going live. So don't miss an episode of our live streams. I would love to have you as a member. Perhaps you're not ready yet. That's fine. At least join us on our free live streams. And what you're looking at here is the PE ratio on the Schiller S&P 500 index. And you can see that even though we've come down this week for the obvious reason that the stock market has corrected some, we're still very, very expensive. A PE ratio on the S&P of 31.13 is way beyond the historical mean of 17.05. So if you think that 1 or 2 days of corrective action in the face of rising yields is going to fix the problems that we have, it's not. It's not going to happen. And the reason why I'm so confident in saying that is that there's another chart out there. And that other chart, that other chart is another chart I keep talking about constantly, and that is the chart of the yield curve. The yield curve has predicted every single recession since 1955. Now, yesterday, the yield curve broke out. Now, we've been looking for this. This is a weekly chart. I'm going to go to a monthly chart in a moment. Now, what we've been looking for is a higher low on price and then a breakout to new higher highs on a closing time frame. This is not a closing time frame. This is a weekly chart. We have 2 trading days left to go before this is closed out. But if we close above this line in blue here, that would mark a significant higher high. And we don't even need to close above this upper band in blue. All we need to do is close above spot 88 on the 2s versus 10s spread on the yield curve. Now, this morning, let's take a look at where we're at right now on the yield curve. So the 2-year treasury, the lines to watch here, the 2-year treasury and the 10-year yield. 2-year treasury yield versus 10-year treasury yield. And you can see that the 10-year is now moving higher. I'll move this around to ensure that you can see it. Is now moving higher yet again versus the 2-year. Now, what does that mean? It means that the inversion of the yield curve is steepening, meaning it's going up further now. If you're a bull and you want to be long of equities, it's the last thing you want to see. Why? It's because if you go to a monthly chart here of the yield curve, you could see that we have now a new monthly high. This does not account for this morning's price action. This is end of business as of yesterday. This is a new higher high on the month. And for you got folks out there, your eyes are glazing over. What's this guy talking about? What does this mean to me? What it means is that you're seeing yield curve normalization, meaning longer dated maturities are having their yields move up higher relative to shorter dated. That's normalization. The problem is that it's not a bullish event if you're looking to be long of stocks on a historical time frame. Because if you go back to 1999 to 2000, this is the dot-com bubble. What was happening then? Yield curve steepened. Go back to the financial crisis, yield curve steepened. Go back to COVID, yield curve steepened. What's happening right now? yield curve is beginning to steepen. Early stages here. Maybe it'll fail for all I know, and we stay inverted on the yield curve for a while longer. I don't know, but all I'm saying is right here, right now, at this snapshot in time, you need to be starting to think about the L word. What is the L word? Liquidity. Liquidity. Get your capital reserves up. Consult your financial advisor. Is liquidity right for you? Does he know what the yield curve is? Really, ask him. Do you know what the yield curve is? Do you know what happens when it steepens historically? Don't let him go to his computer and type it into the computer and do a Google search. It'll probably take him a half hour to figure it out. I'm telling you right now, it's not good. The other chart that we're looking at before we go to the pre-market is the chart of the triple Qs. Now, yesterday we went into the day long of puts. Now, during the morning bloodbath on the Qs, we booked profits on those Qs. We got a rally back. Now, those options that we booked profits on, those expired in September. Now, my guess was, because I was watching the yield curve on my phone, was that we were going to see a continuation move lower. So as equities rallied, we began to open up a new long position on not the September puts, but the November puts, giving us a couple of extra months. Why didn't I go into December or January? Because those are seasonally, not January, but December is a seasonally favorable period of time, meaning you get the Santa Claus rally. So we bought the puts going into November. We'll probably be out way before then, but we wanted duration. We wanted time. We did not want time decay. Now, our other positions are short bias, meaning we have positions on that are what you call strangles, but they're biased to the call side, meaning that we want them to decline in value. That way we could book profits on our position because we're option sellers, not necessarily option buyers. The put positions I'm putting on long are only to protect my short positions. So that's what we're doing right here, right now at the Contrarian Trader. We have a 14-day free trial offer, link below. All right, let's go to the pre-market futures. Oh, before we go to that, I want to finish off with the Qs, what we're looking for here. Sorry, I'm a little bit scatterbrained. It's 5:19 a.m., and it's a little bit early. I don't usually talk to people this early in the morning. So momentum going in the wrong direction as measured by Stokes. What matters the most is this. Do we close down below 373 per share today? If we do, that is a breakdown on the triple Qs. You could argue that we already did it. I drew my line very conservatively here, but you could argue, looked over at Investors Business Daily. They have a shorter support level that they use right down here at about 375 on the Qs. I went a little bit more liberal, so we don't get necessarily too aggressively short too early. Simple as that, because historically, being short is a more dangerous game than what is being long, because you have a long bias in the market, by far. So we want to be very, very careful with what we do here. So we're looking for a break of the support level, and most importantly, not just a break below it, a close below it. If we get a close below this support level today, that marks a new lower low and a follow-through double top, or a confirmed double top on a daily time frame of the triple Qs. Why am I using the triple Qs and not the S&P 500? The reason is because there are 7 stocks that have driven this market up, including the S&P higher over the past several months, namely Microsoft, NVIDIA, etc. And those names are probably going to continue lower. If we break down below and close below the support level today, we're going to lean in more short on any counter trend rally today or tomorrow. If they try to rally, and I predict that they will, they try to rally the equity market back to try to capture this very, very critical support level on the triple Qs. Let's go to the futures action. Okay, I'm actually going to kick it off here this morning on the futures with gold, because many people believe that gold is a safe haven to go when you get a stock market correction. No. The reason is that gold, the gold mining stocks, will go down with everything. Everything will go down because people have forced liquidation. They need to sell things to get out of margin calls. Doesn't matter what they are. It's indiscriminate. So that's why you don't want to go running into gold right now. It'll be the first to recover, but you don't want to go into it right now. It will go down with the rest of the market. If in fact we open lower, maybe they're going to rally this back and open the futures up positive by 9:30 a.m. Eastern Standard Time. I'm just giving you a snapshot of the here and now in the face of what happened yesterday. So gold at current is down on the session, not horribly, but it is down. The 10-year yield is at a new higher high at 4.14. Let's do something on a historical basis. And again, we're going to revisit this tonight on Thursday Night Stock Charts Live. So click that notification bell. Here's a yearly chart of the 10-year yield. And we went over this on one of the live streams. It was either Sunday night or Thursday night that we went over it. And we were looking at a breakout from last year. This year we have not a continuation breakout, but a bullish key reversal bar. Again, one of my top 5 favorite candlesticks. Link below, 5-part video tutorial. And we're looking for a breakout here on the yearly 10-year. Now, remember what I said earlier, that the 10-year at current, pull back here a little bit, the highs of the session was 4.142. Last year's high was 4.25. We're only a blink away from taking out those highs. And in fact, if you take a look at a daily chart from yesterday, we broke out and closed above. Actually, no, that wasn't a close above. Now, if you look at this chart, this is a daily chart of the 10-year yield. You can see that we have rallied through, and we didn't put in a closing high, but very, very close. We put in an intraday high for the year relative to the highs back in July. Now, at current, again, going back to the high this morning, 4.14, we have completely blown through the highs of last month. The question is, do we close there? So we're waking up this morning to a market that is seeing interest rates rise. Why is that so important? It's because the borrowing cost of companies goes up measurably. If they're paying more to borrow more, that hurts their earnings per share. So if this continues, you're going to see this PE ratio, if their business doesn't grow commensurate with or greater than the rise in inflation or the rise in interest rates, rise in interest rate costs, you're going to see this PE multiple rally if equities do not correct to reflect higher borrowing costs. Let's continue on with the pre-market futures. If you have a comment, leave it below. If you agree, disagree, leave a comment. If you have a question, leave a comment. Even if you're not a member, I don't care. I want to help people. So the NASDAQ 100, which is in essence the triple Qs this morning. Let's go to this chart. Down 0.4%. They're off their lows of the session, which is good to see. So here's our upper band of resistance, lower band of support. So these are levels that we'll be watching from time to time throughout the day. Now, individual stocks, how are they doing in the pre-market? Remember, it's very, very early here. Meta, we have a short bias position here. It closed at 314.31. Last tick was 312.50. We were even lower. We were down to 309.78 on Meta earlier. So right now it's testing, it's rising, lower band of support on a daily chart. MSFT, we have a short bias position here as well. This one we could probably take off for a profit today. Last tick was 326.5 relative to the close of 327.5 yesterday. So again, another trade where it's working in our favor because we were short bias neutral, right? We sold premium. We want to be the casino, not the gambler. We sold premium with a bias to the call side, betting that there was going to be a correction, and that way that call side option that had greater value is decreasing in a rate of change greater than the increase in value of the put side. And sometimes there's going to be an equilibrium, and then we take the position off the table and we book our profits. So Microsoft looking good. We also have a position in Netflix. And Netflix closed at 329.70. It's down fractionally at 329.11 being the last tick. Looks as though we were down at support at 425 earlier in the session. Now taking a look at VIX. VIX has a new daily higher high today. It's pulled back off of its session highs, but it still is very, very strong. The VIX has been very, very sleepy, but if you take a look at a daily chart, from yesterday, the VIX broke out. So this is the fear index, right? So the charts we're watching here, VIX, we're watching the yield curve, we're watching the break of support on the triple Qs, and we're watching the 10-year yield. Those are the top 4 stock or the indexes that you should be looking at, and we will be going over them tonight on Thursday Night Stock Charts Live. Join us there. Click that notification bell. Have a profitable trading day. I'll talk to you soon. Be well.